Good afternoon, everyone, and thank you for joining us today. My name is Eric Gould. I'm a member of the MAPERS board. And a copy of today's presentation can be found on the events page of the MAPERS website. A link to the handouts was also included in the reminder email that was sent earlier today. Today's webinar, The Case for Non-Traditional Fixed Income in Every Rate Environment, is sponsored and presented by CIFC Asset Management. And during the presentation, Stan will be asking some questions, seeking participant feedback. So if you would keep your participant window open, and then when the question is asked, there is a little button to raise your hand in the bottom or lower right corner. And all you have to do is press that, and that'll give us an opportunity to get some feedback and help Stan move along based upon our responses. For questions, they'll be handled at the end of the presentation. Go ahead and submit your questions using the Q&A button in the Zoom app. And they've already planned to allow time for questions and answers. CIFC Asset Management Managing Director, Sakura Moriuchi, is now going to provide some introductory comments and introduce today's speaker.
Thank you, Eric, for the kind introduction. We definitely like to thank the MAPERS organization for allowing us this opportunity today to host this webinar. We wish we could all see you in person today and appreciate you guys taking what might be your lunch hour to spend some time with us. So as Eric just mentioned, my name is Sakura Moriuchi, and I am a Managing Director in Investor Solutions at CIFC Asset Management. We are actually a new member to the MAPERS organization. So for those of us that may not be as familiar with CIFC, we are an alternative credit manager with a specialization in corporate and structured credit. So we are very known in the leveraged credit space for being active relative value traders. And our firm was founded in 2005 by the then Chief Credit Officer of Jpmorgan. And our firm is now over 28 billion in size and headquartered in New York with another office in London. So we do have a broad investor base across kind of the globe, public and private institutions, insurance companies, foundations and endowments, family office and private wealth clients kind of make up, our 28 billion AUM today. So for those of you that may not have met with us previously, we look forward to hopefully one of these days engaging with you in person. And in the meantime, with me today is Stan Sokolowski. He's a Deputy Chief Investment Officer and Senior Portfolio Manager at CIFC. So Stan is actually a Spartan and remains very active with MSU through both its foundation as well as, I think many of the guys who attend his guest lectures say that they're rather colorful. So he does some guest lectures back at the university from time to time. Prior to launching our corporate credit program at CIFC, Stan was basically managing an unconstrained credit portfolio under Bruce Kovner at Caxton. And before joining Caxton in 2006, Stan was based out in London at Jpmorgan, and he founded and launched the European par and distressed loan trading business there. So Stan's career kind of through and through has always been in credit to date. So what we're going to be focusing on today is around the challenges of investing in today's market environment. So specifically, we'll be addressing the issue of income. So this issue of needing income is, basically what we found is inclusive of almost every institution and investor type. And pensions in particular, continue to face funding status pressure, and globally, investors have just been facing tighter pressure on yields. So being a specialist in credit, we wanted to share some data, present some thought leadership and solutions that we've shared with our clients to date, and walk you through our title presentation today around non-traditional fixed income in today's investing environment. So what we're going to do is we'll lay the foundation of our dialogue by tying in both the current macroeconomic backdrop, Fed policy, and inflation expectations to get to what this means overall for the traditional fixed income markets. So we believe that, a lot of the traditional 60-40 models and risk parity strategies are going to be facing immense challenges going forward. So we want to share with you why we are big advocates of fixed income alternatives such as broadly syndicated loans and high yield bonds. So as we walk you through some of our ideas on the complements and replacements for traditional fixed income, we'll also share a case study on floating rate asset performance in varying interest rate environments. As you know, we kind of went from a floating rate environment where that was a big benefit to floating assets to now a zero rate environment, right? So we kind of want to walk you through the different market environments and how floating rate assets perform there. And then we also want to present other various alternatives, right? To hopefully relay what is a more balanced view of the tools and options that are available to you. So again, today, this session is about being helpful to you guys. So we welcome your questions and comments, and hopefully we get to answer all of them. So with that, I hand this conversation over to Stan.
Great. Thank you, Socorro. Thank you, Eric and Michelle and everybody at Mapers for joining us today. It's always good to be home, even if it's virtual. As Socorro said, I'm from Michigan originally. I actually grew up in Pinckney, right outside of Brighton, so that's halfway between Lansing and Detroit. So I hope Socorro didn't offend at least half of our audience with my alma mater, but go green, go Sparty. And finally, I guess I would say, we're doing this virtually. I can't wait to get back and see many of you again when our world returns to normal. So I hope you and your families are doing well. And then Socorro, nice job. I think you did a great introduction there, in particular hitting on a lot of the themes that are pressuring many of you in the audience today. So with that, I'll move on to page number 3. Here we go. I always tend to quote Jesse Livermore these days. Everything you need to know is right in front of you. And there's a lot of obvious statements on this page, but where are we now? The world is essentially, as Socorro highlighted, we're in a full zero interest rate world. And many of the secular trends that were already occurring globally were pulled forward by COVID. So what do we know? We know rates will stay low and finding income is going to be a challenge. As Socorro said, we'll focus on some of those solutions for you today. Unfortunately, for many of my conversations, it's apparent that some folks don't really appreciate the implications of Fed policy these days, and we'll drill into that a little bit more as well. Rate markets, they're just not providing the safety, the income, or the price appreciation they once did. On the other hand, duration is certainly building in these asset classes and is definitely a bubbling threat. The 4-decade party and lower interest rates is basically over. So returns are going to be low returns are going to be the norm, and volatility is set to follow. I guess I would just highlight driving in the rearview mirror these days is pretty dangerous. And we will provide some specific charts and pictures to help visualize what we're talking about. So largely, we're in the midst of a risk return crisis in traditional fixed income asset classes. I'm sure many of you are experiencing it both personally and professionally. However, our job as fiduciaries has not changed. Return-free risk is not an answer. Our job is not to avoid risk, but to ask if we're being paid appropriately for the risk we're taking. And then finally, one programming note here. We believe this is a potential golden age for income alternatives. Conservatism abounds, whether it's from investors or issuers. It's my view that keeps bullish tendencies in check and makes many potential solutions appealing. So more on that later. I'll move to our next page, page number 4 here. And before I get into our slides, I'll make some comments. And I think here it's fair to throw in another quote, and I use Frank Stanton here, but folks making predictions, pundits, journalists, the smart folks, they lack steady reliability, scientific methodology, or real life consequences for the forecasts that are made. So I cannot predict the future. However, as a fiduciary, it is my job to be as right as often as possible, but more importantly, be positioned to survive when many others may not. So I base my views on signals I see in the market, and I attempt to understand as many differing opinions as possible, even when my own personal biases disagree. So with that, I'll present you the bull narrative and the bear narrative. The bullish side today discusses the fact that the recovery continues, vaccine progress is moving forward, we have fiscal and monetary support, and the election is probably going to be decided in a more normal manner than many expect. Conversely, the bear narrative today is that the rapid recovery we've experienced over the past months has concluded and growth is now plateauing. Additional fiscal policy appears to be on hold for now. Zero interest rate policies are a bad thing, not a good thing. I'll note Japan here. I think we're now into the 21st year of their zero interest rate policies. Little trivia there. Infection rates are increasing again, and then obviously the US election is going to create a lot of indigestion. So those are the two positions. And once again, by the way, if I could predict the future, I would be self-employed. So Socorro has page 5 up here, the state of the economy, and we'll just set the scene here, and then I'm going to try to go to a couple of questions. So upper left, those are equities. They're basically at all-time highs or hovering close to. In the upper right, fixed income markets are basically at all-time highs in price and all-time lows in yield. And then on the bottom left, you can see volatility certainly higher than the base with those spikes that continue to surprise many. We seem to get a once-in-a-lifetime crisis every 10 years these days. And then on the lower right, the World Uncertainty Index, probably no surprise, that's been trending up for a number of years now. So as a starting point, I know what I do not want to be invested in. So I'm just going to stop there for a minute, guys, and ask a couple of questions. And as Eric said, there's a participant button at the bottom. I think if you click there, you can get to your hands up or hands down on the lower right of that participant dialog box. First question, who's bullish? Virtual hands. Wow, either I'm on mute or nobody's bullish. I do have a couple bullish hands. All right, let's turn the telescope around. I'm going to clear out those hands. And let's go to who's bearish? Question, hands up on that one. All right, guys, you're making my job difficult here. I got a couple of bearish hands. I was hoping to get a bit more from you, but I'll go with it. I guess this environment is making it hard to be either, quite frankly. There are days when we want to feel bullish and certainly days when we want to feel bearish. And I think, the past few days has been an example or a case study of that. But why don't I move on to page 6 and let's talk about what we're looking at here. This is the Fed's balance sheet. So we can see the Fed has certainly been active in purchasing securities. That's on the upper left. That's part of their programs here to provide monetary support to both markets and the economy. And then on the upper right, we can see how GDP has recently responded to the COVID crisis. But to me, more importantly, on the bottom half of this page, we can basically see as a percentage of GDP what this monetary support really looks like. So money is everywhere. I haven't been an inflationist, but I am beginning to appreciate the arguments on the other side. I do know one thing: if inflation does come and a portfolio is not prepared, I think beneficiaries, investment committees, bosses, and quite frankly, ourselves are going to ask, why were we not prepared? So we can't predict the future, but we can prepare for it. Let's move on to page 7. Inflation expectations. Certain inflation markets and certainly central bank activity are presenting investors with some signals. So 5-year break-even inflation rates on the upper left, that's the Fed, one of the Fed's preferred gauges of how inflation is trending. That certainly has bottomed and it's moving up. It doesn't look like it did a decade ago, but it's kind of stopped collapsing post-COVID. On the upper right, we can see the price of gold, historically and a indicator of views on inflation, among other things. In the bottom left, we can see the M1 money supply. This is basically cash and deposits in circulation. That's spiked dramatically. But also on the lower right, as a change year on year, there's been a dramatic spike in money supply. So again, markets and actions are telling a story here. Page 8. I was surprised when I sent this chart to a bunch of clients, and what surprised me, surprised myself, I didn't know and nobody else knew. So what are we looking at here? It's a collection of sovereign bond yield curves. So that the top dotted line, that's the United States. Actually, it's a nice shape for a yield curve. But if you look at the vertical axis, you can see you're basically not getting paid unless you're taking 30-year risk, and even then you're getting 1.5% approximately. That next dotted yield curve below the United States there, that's Japan. And you can see that's negative below 0. So basically give your Japanese government the money for up to 10 years, and at the end of that time frame, get something less back. If we look at the collection of solid lines below Japan there, that is the yield curves of a number of the major European sovereigns. And I think what's interesting there is they are all solidly negative. So there's an income problem. Investors globally have this income problem. But who knew that Japan, which is the poster child of low inflation, low rates, low growth, and secular demographic trends, would be yielding more than most of Europe? Okay, next page. On page 9, basically what we're looking at here are 5-year yields. Once again, we're focused on the European majors, but we've also sprinkled in some of what are referred to as lower quality sovereigns like Italy and Greece, and then the United States. So many investors have resigned themselves to these very low and even negative income streams. Many are pushing out. We have clients that do 10-year, 20-year, 30-year, and they're stretching. They want to get a few extra basis points of yield. But if it goes against them, it's going to hurt. And that hurt really comes in the form of duration risk. All right, we'll move to page 10. The fixed income conundrum. And I think many of you in the audience are familiar with this page. What are we looking at here? Total negative yielding debt outstanding in the world today is over $16 trillion. Corporate debt on the upper right there, almost $1 trillion of negative yielding debt stock. On the lower right, those are the 10-year rates, so it looks a lot like the 5-year rates we just showed you on the previous page. But in the lower left, the Barclays Agg, which has been a proxy for many investors as they invest into bonds over the past decades, you can see how the yields have declined dramatically there. Today, you get 91 basis points, 0.91% yield for about an 8-year duration and a 10-year maturity. What does that mean? It essentially means if bonds move 10 basis points, a little over 10 basis points, you've wiped out a full year of income. I'm going to move on to the next page, page 11. and we'll dig into this Barclays Ag. And I think the reason why I focus here is many of our clients globally, and in particular the large pension funds who we partner with, they do invest in the ag. Some of them have been reducing, some have been replacing. Nobody is comfortable. But here, in a little more granularity, we get back to the risk-reward crisis that's bubbling in traditional fixed income markets. And on the upper left, we've shown the global aggregate. On the upper right, we've shown the government global aggregate. On the lower left, we show just the emerging markets, and on the lower right, just corporate. So you can pick your poison. Yields are going down. That's the dark blue line in each of those charts, while duration continues to trend higher, and that's the gray line that's on an upward slope. As I said earlier, trouble is brewing. Next page. A little bit more on the embedded risks in traditional fixed income. I hope some of these slides will help you and your colleagues and your investment committees as you're making decisions. That's a lot of my emphasis here, but again, coming back to duration and fixed income risk and safety, we can see the investment grade index here on the upper left, and duration has been extending. Obviously is exposing investors to higher volatility. The chart basically says that chief financial officers of the companies issuing these bonds are smart people. They have been extending that maturity on their liabilities as rates have declined. That's good corporate finance sense. However, that picture is a vivid reminder that investors are taking more risk for less return. From a safety perspective, the bottom half of this page, we have two charts. I'll start with the one on the left here on page 12. These are a couple case studies that were in the Wall Street Journal a couple weeks ago. And essentially the chart on the lower left shows that as we entered the COVID period, rates, when they had some convexity left to them, the dark blue line, they traded up, which is kind of what's supposed to happen when there are periods of crisis and recession. And you can see as equities traded down, the gray line, you offset some of your losses with that traditional exposure to fixed income. So it worked, or worked partially. If we look at the lower right, as we got into the volatile month of this past September, and basically yields were squished down close to zero, certainly below 100 basis points, and we had this equity market sell-off, the rate market didn't respond like it historically did. And it didn't provide the offset to the equity losses that occurred. It was a fraction of what was achieved here as we entered March. So this is the paradox of the risk parity strategies that are used by many of you in a zero interest rate world. Page 13. So where do you go? What do you do? This page we use, this is Jpmorgan's long-term capital markets assumptions. I believe this is available on the web if any of you want to change it up a bit for your own personal use. But essentially what Jpmorgan does is they annually reassess their 10 to 15 year return view on a variety of asset classes. And from an investor perspective, you know how you want to be positioned, you know what your own goals and objectives are, you know how much money you need to put to work. Obviously, these are all client-specific questions and they all have differing answers. The point of this slide is to demonstrate that there are choices. You could buy US small caps, and obviously those returns are certainly below 6% these days, or expected to be below 6%. On the other end of the spectrum, there's commodities or world government bonds. The choices here, they're gonna, again, be based on risk tolerance, target returns, and liquidity needs. But again, based on these projections, I know what I do not want to be invested in. I'll move to page 14 here. All right, what does this all mean? In my opinion, policy is driving us, and it's causing this risk-reward crisis for those investors who do require income as a part of their investment plan. Duration has increased materially. That means your risk is up. Risk should not be avoided, but it needs to be priced and better balanced in portfolios. And as I said earlier, I think non-traditional income asset classes are entering a golden age, and pendulums swing, and we're certainly swinging to alternatives right now. All right, next page, we're going to start moving on to the solutions portion of our presentation. But maybe I'll take you guys back to that participant box for a second and ask some questions. So at the bottom of your Zoom, there's a participants. If you click that, I'm going to try to get some virtual hands again. And I'll start with this question, guys. Who thinks the 10-year U.S. Treasury will be back up and about 2% by the end of 2021, just like it was pre-COVID? So a year and a bit from now, 2%. Any hands? Okay. Next question. We'll clear those. Who thinks interest rates will kind of be where they are today? They won't go up. If we get a show of virtual hands there. I can certainly see the consistency with the bulls and the bears. And once again, guys, the answers are pretty evenly balanced. Bummer. I always like it when we lean one direction or another. It gives me some free information to take back to the boss. All right, we'll get back to the presentation. We'll come back to questions later. All right, hopefully we made some good points for you, but now what? How do we solve this puzzle, and what are the possible solutions? And with that, we'll move to page 16. Let's start here. This is a chart we borrowed from Goldman Sachs and Bloomberg. And essentially what this shows on the top half is a variety of different asset classes from the depths of the crisis in 2009 to this past summer, the performance, the cumulative return. And I think we all know from our personal experiences and the classes we've taken over the years that equities traditionally are associated with the greatest reward. And over this time period, that was no different. And you can see that most equity classes, or most equity asset classes, were some of the best performing markets over the past decade. However, many of us can't just buy and hold and assume all that volatility, because it's certainly stomach churning, and not always does it fit the goals of the portfolios we're managing. So what Goldman did on the bottom half of this chart is they risk adjusted these same asset classes for that same period of time, and another picture emerged. And if we look at that picture on a risk adjusted basis, your best performing asset classes were basically credit and income performing asset classes. So that's great, right? You could say, good job, Stan. You just told me what happened over the past 10 years. And I think it's important to think about what was going on over the previous 10 years. We had these secular pressures. We had a lot of volatility, and we had a lot of monetary support. If we look forward, it's my belief that a lot of those conditions are going to continue, and that if we're back speaking with all of you again in this format 10 years from now, I'm probably going to show you this same page, and my guess, it's going to have a similar profile. So credit actually did well, and that's a lot different than what the newspapers tell us. So I regularly remind myself and my clients, don't believe everything you think. I also quote Mark Twain here. If you don't read the newspapers, you're uninformed. If you read the newspapers, you're misinformed. So credit is probably one of those solutions. I think structured credit is probably one of those solutions. Preferred shares are probably a solution, and even dividend paying strategies are probably a solution too. So my idea is not to give you answers. My role here is not to give you answers, but to give you some ideas and let you resolve those questions for yourself. All right, next page, page 17. Again, here are some of the solutions that I just mentioned, turning it around a little bit, looking at asset class yields. So what can you get today? And is the risk reward balance what you're attempting to achieve? Structured credit securities like collateralized loan obligations, the double B bonds, they're paying pretty handsomely today. In fact, I noted yesterday, Oaktree, Howard Marks distributed a write-up to their clients on CLO opportunities. So I'm tongue-in-cheek telling people that I think Howard participated in our last presentation. Anyway, you can see where high yield and leverage loans and those preferred equities that we highlighted again, also triple B CLOs. So there's some pretty good yield out there, especially when you look at a 10-year Treasury that is below 1%. And then on the other end of the spectrum, it does a sub 1% or sub 1.5% return profile fit your needs? Maybe it does. But in a 10-year security or greater, again, there's a lot of brewing risks there. On the next page, I know what you're thinking. Don't these securities entail credit risk? Yes, they do. And as I think about that question, and I answer it with a yes, it's just like most things in this world today. There's a lot of nuance to that answer. So what are credit spreads telling us? Well, along with volatility, along with uncertainty, credit markets are no different than a lot of other markets. When these once in a lifetime crises pop up every 10 years, credit spreads spike. But overall, they're kind of in a zone right now, which is in the zip code of where they've been going back for a number of decades. So the short answer to my question about what credit spreads are telling us is that other than the most draconian scenarios, investors are getting paid today to take credit risk. And I'm gonna show you the math behind that in a slide or two here. So that's credit spreads. Page 19, how about those floating rate short duration instruments that people talk about? And the question I most regularly get here is, well, don't they underperform unless interest rates are moving higher? I wish I had a nickel for every time I heard that question. That's fake news. And I'll show you a quick analysis here in the lower left-hand corner. We borrowed this one from Credit Suisse. But essentially what Credit Suisse did is they looked at traditional fixed income asset classes as represented by the aggregate as well as US Treasury bonds. And then they also looked at floating rate short duration asset classes, and they used loans here as the proxy. They looked at 3 interest rate environments. On the far left of that chart, they looked at rising interest rates. In the middle, they looked at flat interest rates. And on the far right, they looked at falling interest rates. And obviously, in a falling rate environment, bond prices go up. We all know that. So there's a great tailwind. However, those short duration floating rate instruments, they didn't do too bad. In a flat rate environment, once again, everybody kind of performs in line, generates income. It's probably good. Loans paying a little bit more than that traditional fixed income. However, when we get to that rising rate environment, those floaters obviously perform because they pick up the tailwind of rising rates. However, the headwind that impacts traditional fixed income gives a very imbalanced picture here across a number of rate environments. So, as I said earlier, don't believe everything you think. This is loans in particular are a very stable asset class in a variety of interest rate environments. Okay, bear with me here, guys, but I'm going to give us a word on risk and reward, and I'm going to stick with the credit markets for this discussion because that's my DNA. And let's start by talking about risk. Many investors are concerned that they're taking risk and that they will lose money. That's true. They're misguided, however. Risk is the essence of investing. The definition of financial risk is the possibility that you may impair a portion or, God forbid, all of your capital. Investors get paid to take risk. Investors get paid to take risk in the equity market. Investors get paid to take risk in the bond market. And yes, investors get paid to take risk in the credit markets. So the concern about risk and taking it is probably the wrong question. The correct question, in my opinion, is, are you getting paid to take risk? Now in credit, and I'll leave equity markets and traditional fixed income markets to smarter folks than I, but In credit, the way we think about risk is through a term called credit costs. What are credit costs? Well, that is your defaults multiplied by your losses. The product of that equation are your credit costs. And all credit investors are exposed to them. The big banks are exposed to them. Jamie Dimon at Jpmorgan is exposed to them. Any investor in a credit product is exposed to them. So when you take credit costs and you subtract credit costs from your income, you will get your excess return. And that is essentially what you're getting paid for the risk you're taking. So as you can see from this table here on page 20, we put in a variety of outcomes, and we start by looking at the far left column. Those are default rates. You can be bullish or bearish. 0 defaults, probably unlikely, or 15% defaults at the bottom, probably unlikely. Along the top, you can see recovery rates. That is the inverse of loss rates. So again, on the far left column, we have default rates. On the top row, we essentially have recovery rates, the inverse of loss rates. You multiply loss times default, and you'll get a credit costs. If you subtract that credit costs from the income, and that's down in the footnotes, you can essentially see what your return profile could look like. The red is not good. But again, if we have 10% defaults with 70% loss rates, 30% recovery rates, it's going to be a very draconian world, and I suspect the rest of your portfolio is going to look like dust. You can see in the green, this is my opinion of kind of how the world is shaken out over the past number of decades. Call it 2 to 4% defaults with losses in the 30 to 40% zone, so recovery 60 to 70%. So this can give you a sense of how your credit portfolio could perform. By the way, guys, it took me 20 years to understand this math, so sometimes it's a bit of a struggle on this concept, but if you want to review this at any point, please let Socorro and I know. We do it for a living. We're happy to talk to you. Okay, we'll move on to the next page here, page 21. And essentially, here's another market. This is the high yield bond market. There's a little more red. There's obviously some green based on history, but I think the messaging again is there is opportunity as well in the high yield bond market. On the next page, we're page 22 now, giving some historic performance on a couple of the solutions we highlighted. The top half of this page is the Jpmorgan CLO BB index. Unfortunately, they only got that going about 8 years ago. And it gives you a sense of what that return profile looks like and where your down years may be and maybe what you could expect to earn on average. So once again, not a bad profile. I understand why Oaktree is out there showing this opportunity. On the bottom half of this page are preferred stocks. We picked a preferred ETF to represent this return stream. That ETF was established in 2008, but that's down in all the footnotes for those of you who want to look at that. Moving on to the next page. Couple more solutions that we highlighted. These have much longer dated track records. Leverage loans on the top half here. Only one down year going back to 1992, 30 years by my math. Not bad. High yield bonds on the bottom half of this page, 5 down years, but a 9% average return profile. Once again, call me old fashioned and biased, but those look like decent return profiles, especially in a zero interest rate world. Once again, this is not without risk. And I will tell you, if you expect a crisis, do not invest. But again, based on this most recent crisis back in March, I don't know of an asset class that performed during that 3-week grab for liquidity. By the way, that includes treasuries, investment grade bonds, and even gold. Okay, page 24, I'll sum up and then I'll try to ask a couple more questions. And and then we'll turn it over to Q&A, and hopefully there are some questions from you guys. Where are we? Essentially, it's been a Japanization of developed market bond markets. On the flip side of that, we got a very supportive group of central banks, the Fed being the most obvious, but that's providing a good backdrop for non-traditional income assets. Investors have been presented with a very clear and vivid roadmap. The environment we're in today, well different than the one we previously operated in. As I said, solutions do exist, but the key question is, am I getting paid for the risk I'm taking? So I'll stop there. I'm going to force you guys back into your participant box, please. I'm going to try 2 more questions here. So if we can get a show of virtual hands. This one will be on the S&P 500. The next 10% move, will it be up or down? So I'll start with up. Who thinks the next 10% in S&P will be higher and upwards? Virtual hands, guys. All right, we're starting a bit more bullish this time. How about, all right, I'm gonna clear that one off, guys. How about who thinks the next 10% move in S&P is gonna be down? Any hands there? Interesting. I'll tell you what the theme of all of the Q&A, or my Q&A today has been. It's a very balanced world. All right, we'll clear those off, and I'm gonna ask a question about inflation next. I guess we'll use December 2021 as our dateline here, but who believes inflation will be above 2% basically a year and a bit from now? Virtual hands. Okay, I'll clear that. Who believes inflation will basically hover around here, or certainly not be a very positive number? Wow. So guys, this question got our most responses today and leaned most bearish. Many of you don't believe in inflation. So that's going to say a lot about the upcoming portfolios you're going to be putting together. The duration risk is out there. If the Fed, and it's not clear to me they're going to be successful, but if they are, there's trillions of dollars of traditional fixed income portfolios that are going to be hurt. But I'll stop there. I'm going to turn it back over to my colleague Sokolowski now, and hopefully we'll get some Q&A, and I'll give it back to Sokolowski.
Hey, thanks, Dan. Well, hopefully everyone listening today had some good takeaways. I wanted to open it up for a Q&A, which unfortunately, Eric, I think I might need your help. I'm not able to open the Q&A window.
Okay, so our first question is, how do you feel convertible fixed income strategies fit into our portfolios at this point in time?
Yeah, converts are certainly an option. I guess I would ask a question back: how much money do you have to put to work? Because if you're one of the larger pools of capital out there, the convertible market is pretty small. But from a philosophical risk-taking perspective, I like the exposures you're getting there. You're getting the equity component and you're getting a debt component. And that lines up with the answers to our questions today, guys. I think it's hard to be bullish in this world. It's hard to be bearish, super bearish. It's hard to believe rates are going up. It's hard to believe they're going down. Our inflation question leaned a little bit towards low inflation, but I certainly believe it's an alternative.
So Stan, if you don't mind me following up, so what, I guess, what would be the the difference, or at least as it relates to the strategies that you've been talking about, what are the major factors that distinguish and differentiate this approach and its advantages versus a convertible strategy?
Yep. So I think it goes back to the three questions I highlighted earlier. And at CIFC, when we partner with our clients, we ask three questions. What's your risk tolerance? What are your liquidity needs? And what is your target return profile? So kind of coming back to those other variables that play into a lot of our investors' decision making, it's volatility. Look, I would like to make double-digit returns every year for the rest of my life. It's kind of hard to do it in a low return world, but it's more difficult to do it when your portfolio is getting whipsawed by volatility. And once again, March is another great case study. And by the way, from the depths of March to where we are today is another great case study. If you're going to buy and close your eyes and your fiduciaries, your board, your boss, everybody's going to leave you alone, go for it. But I think a lot of the investors that we're working with today, they don't want the volatility profile of traditional equity markets. They don't want the duration profile of traditional fixed income markets. They're looking to generate yield in their portfolios to replace or complement the 40% of their 60-40 risk parity strategies. And then most importantly, in a low return world, they don't want to pay a lot of fees. And it's pretty simple what folks are looking for.
So maybe we can explore the duration risk a little more and provide some insight, at least as it relates to the strategies that you've been talking about. What type of, is there a specific duration period that's subject to your focus, or what are sort of the qualifications or key factors that you're looking at in developing this investment strategy?
Yeah, that's a great question, because when I graduated with a degree in finance from Michigan State University and began my career, I didn't fully understand duration, guys. And I don't blame my professors, although I do tell Professor Siminoff that he needs to focus on this, but it took me a number of years to understand. So let's just talk about what duration risk is. We all know, or I think most of us know, that when bond prices go up, yields are coming down and vice versa. So duration risk is essentially your price sensitivity to that move in interest rates. And to make it simple, if you have a 10-year bond and interest rates move up or down by 1%, 10 times 1 is a 10-point price move. That can be a 10-point positive price move or a 10-point negative price move. And when interest rates, in normal interest rate environments, duration can be managed. There's a lot of strategies. You can benefit from it. You may take some losses from it. But in normal interest rate environments, possibly it's manageable. Certainly been a great 40 years if you've been long rates. The challenge is in sustained low rate environments, when interest rates, maybe they could go to zero, maybe they could go to negative 50. But the point is, it can't go materially lower, and therefore your prices cannot go materially higher. So what does that state? Well, kind of suggests that your risk is price losses if, and it's not clear, I'll say if again, that interest rates go up. But what's happening in this new sustained low interest rate environment is a lot of asset classes, whether they're fixed or floating, whether they're long or short, are kind of all looking alike. So in the credit world, the leveraged credit world today, we see a lot of high yield bonds, which are unsecured, subordinated instruments at yields that are matching senior secured floating rate loans. So call me old fashioned, I'll take the same return profile for less risk any day of the week. So these are, to get back to your question, Eric, clients are looking at many of the other risks that they traditionally hadn't had to focus on so much, and they're incorporating that into their investment decision. So if you have two houses on your street that you're looking at buying and they're both at the same price, but one you got to put a lot of money into and one you don't, you know exactly what you're going to buy. And I think that's what's going on in the fixed income. I know that's what's going on in the fixed income markets today.
Yeah, okay, but I guess using that analogy, there are the items and issues that you can see, and then there are certain items and issues that you can't see between both houses, foundational issues or whatever. And so that sort of leads into one thing that I was sort of curious, what type of debt opportunities are we looking at? Are these publicly are these public? Are these private?
Yeah, good question. And I'll start off with my own observation, because you're right. There are a lot of boogeymen out there. There's a lot of panic merchants. There's a lot of risk. And I'll quote Peter Lynch. I hope many of you know Peter Lynch. He was the Fidelity Magellan portfolio manager, very successful portfolio manager at Fidelity for years. And he said, more money has been lost anticipating or preparing for corrections than in corrections themselves. And unfortunately, I see a lot of that from clients over the years. But your question about, well, what is this stuff? What am I getting? And quite frankly, in the leveraged credit markets, you're getting a lot of household names. You know, the big airlines, obviously they're fallen angels today. They're big users of these markets. These are $1 trillion markets, by the way. High yield is north of $1 trillion. Leveraged loans are north of $1 trillion. Household names, Dell Computers, Arby's, Burger King, many big companies. And you know, they need capital to keep the economy going, keep their businesses going, keep employment going. The other sub cohort of users are the financial sponsor firms. I suspect a lot of you have private equity in your portfolio. Private equity investors, when they buy a company, they add debt to it. They come to firms like CIFC to get that debt. So we are the secured part of your balance sheet. So if you're the private equity, you're down here. The secured lenders and the bondholders are up here. So if you're taking private equity risk, basically we're sitting on top of you in the capital structure, which means we're taking less risk, but we're getting paid to do it. And then finally, kind of coming back and tying it all together, yes, there's definitely risk out there, guys. But I go back to the question, are you getting paid to take the risk? And if you're not, or if you feel you're not, don't do it. But I look at the math today, and as I said earlier, in all but the most draconian scenarios, you're getting paid to take the risk today.
And then obviously a lot of us serve as trustees. We have fiduciary responsibilities, and certainly in hearing your presentation, the one thing that I keep coming back to is, is fine. I should be paid for the risk I'm taking, but as a fiduciary, I'm risk adverse. And there's a certain, obviously with equities, there's a certain amount of risk with everything. But if coming from a more basic position, right? If we got three general buckets: equity, debt, fixed income, and then alternatives. And if I'm not, and we've got our investment policies and all these wonderful things, and we're working with consultants, but how can we substantiate and support an uptick, let's say, in risk? And maybe this is more with private debt as opposed to, publicly traded, because maybe we have those, high yield portfolios in the investment mix. But that hammers or weight is sort of lingering over my head.
Yeah. And I sit on a foundation up in East Lansing, and we work with some of these same consultants. And I probably should keep my opinions to myself on what I think the consultants do. It's borderline criminal, in my personal opinion. Some of them are good, but some of them are very misinformed. And you mentioned a whole variety of things. Yeah, listen, you've got fiduciaries. I know where this money goes. My wife's uncle was head of the Bricklayers Union in Detroit. My grandfather was in the International Brotherhood of Electrical Workers. This is important capital. This takes care of people's lives, and we really have to understand what we're doing. And all too often, I see certain fiduciaries who think they're taking less risk actually putting on more risk. And I'll give you a couple of examples. Had a Canadian pension fund piling into 30-year debt right before it backed up 100 basis points. That's a 30-point move in principle. My stomach still turns. Other case studies, you mentioned middle markets. Well, that's been a very hotly pursued private debt strategy in recent years. And if you peel the onion back on what you're actually getting, you're getting a lot of small company risk, which, by the way, is great in good times. But I remind you that companies can control a lot of things. What they cannot control is the economy. And unfortunately, smaller companies are most exposed to low growth and volatile economies. And a company with $50 million of EBITDA can go poof overnight. And that also worries me. In fact, a lot of those strategies also have embedded leverage. So this is hard, and it's hard to reach out to certain folks and ask questions because many of us don't know what questions to ask or what answers we should be getting. But I also remind you that this is not rocket science. There's a lot of common sense and a lot of judgment that gets placed in these decisions. Like I said, I sit on a board and I work with my fellow board members to make these decisions every day. And keep it simple. Do what you know. Don't do something so complicated you're going to regret it, because complexity always ends in tears, in my opinion.
Those last few comments sum things up a lot for all of us. With that, as time is drawing to a close, obviously MAPERS and all the participants want to thank both Stan and Sakura for their time and the presentation. If nothing else, this only goes to demonstrate that that information is the key. If it was easy, everyone would be able to do it and everyone would be successful. And so for our members, please continue to stay tuned and check out your emails for upcoming presentations, because the goal of, while we would again love to do it in our live gatherings, even if though we're virtually together, we still have the responsibility to stay on top of stuff, especially as things continue to change over time. So our next webinar will be a post-election legislative and legal update from MAPERS lobbyist and legal team, and that is set for Friday, November 3rd. Emails will be sent shortly with registration links. And if there's interest in sponsoring webinars, or if anyone has a topic or a suggested speaker, please forward that information to our office. Again, the information that we get from you helps us to provide information and education to you and the entire MAPERS community. So with that, oh, sorry, I was just advised, it's not it's not Friday, November 13th. Can't be the 3rd. Michelle, sorry about this.
Hey, Eric. The next webinar is Friday, November 13th.
Did I say the 3rd? I
You
meant
did.
I apologize. I meant the 13th. No, the 3rd is the important day for everybody to vote if they haven't done so. So with that, and now a slightly red, blushing face, I want to thank everyone at MAPERS wishes all of you, your family and colleagues, good health and continued safety.
Thank you, Eric. Thank you, everybody. Look forward to seeing you sooner rather than later.
Thank you very much.